Hello and welcome to this next module on multiple timeframes and the importance of using multiple timeframes in conjunction with volume spread analysis. I'm here with Tom Williams, former professional syndicate trader and author of The Undeclared Secrets That Drive the Stock Market and Master the Markets. Okay, Tom, one of the most commonly asked questions we get via email at TradeGuider is when using volume spread analysis, what is the correct timeframes in specific markets such as Forex, commodities, stocks and futures? And indeed, is there a correct time frame to use, or should it be left down to the individual trader and investor to find what suits their personality and trading makeup?
There is certainly down to the individual trader what time frame he wants to use. We do not use any mathematical formulas whatsoever. So if we said, right, you've got to look at a 5-minute or any other time frame, then you're boiling it down to a mathematical formula. We don't do that, and you don't have to do that. As a professional trader, you can see all these things in a matter of seconds, which you will see as you get more and more experience. However, saying that, what is quite interesting is that, say you're trading a 30-minute chart or a 15-minute chart, then if you use a 5-minute chart as well, then surely if sign of weakness comes in, it's like an early warning system.
Right.
So that's kind of interesting. You should look at that.
Okay, so let's take an example. Let's say on a higher time frame, like a 15-minute chart, we see a sign of weakness appearing. But when you drill down a couple of time frames, let's say to a 5-minute chart, and say you were using a 10-minute in the middle, you see a sign of strength on the 5-minute chart and you've got weakness on the 15-minute chart. Which is the right chart to trade, and what would you do in that situation?
Well, it would be a warning to you. You see, you can see how these different time frames work. If you get a stopwatch, for example, and say you are following a 10-minute chart, a 10-minute time frame, you can watch the market developing as the market's moving up and down, say, and every minute, if you've got a stopwatch, you can tell when the minute, well, that's your 1-minute chart. Now, I'm not saying you do that, because that makes it very complex, but it's interesting to watch how the time frames build up. If there's a weakness in the 5 minutes, as sure as anything, it would develop into weakness in the 5 and 10 minutes.
If you see weakness appearing on, say, a very short time frame, like a 1-minute, 2-minute chart, if you were a scalper, would you expect that weakness to begin to appear on a longer time frame, such as a 5 or a 10-minute chart, if there's a lot of weakness on the shorter time frames?
It will, and you can experiment looking at that very carefully to reassure yourself that in fact this is so. It is very confusing, and it sounds very illogical. I mean, even the programmer I used when I first started, he said, well, that doesn't make sense. You know, it can't possibly be, follow through like that, because programmers think very logically. But as he developed it, it proved that it did. But it's up to the individual trader to decide what sort of time frame he wants. It'll work on a 1-minute, 2-minute, 5-minute, 15. I mean, only a few days ago, you put up a 15-minute chart of the pound. And I hadn't looked at that recently, the 15-minute, and I was quite surprised, even myself, how good it was.
Let's take a specific example in, let's say, Forex, because this actually happened a few days ago. If you have a serious sign of weakness on the longer time frame, in this instance, let's say it's a 4-hour chart, but you drill down to smaller time frames, to say the 15-minute, and you do actually see a little bit of buying going on, there's a green signal there. Which is the most important time frame to look at? The bigger time frame, where there's a serious sign of weakness behind you, or would you, if it was you, start scalping or buying the smaller time frame or going long against this weakness that's behind you?
It's a risky trade.
Right.
Now, don't forget, too, there's another principle here involved, which a lot of people don't understand. The market may be going sideways. You don't care. We say we're not worried about the background in this case. We're not sure what's going on in the background. But say you see a test. A test is a clear down bar, close in the middle, or even high, and the volume is low. Okay, so you look at that. Now, there is such a thing as a fail test. Now, those professional people are looking at that They never go to sleep. The market doesn't go to sleep. They're watching that. If the market fails to respond to that obvious sign of strength within 2 bars or so, then it has to be a fail test. Right. So that is a sign of weakness in its own right.
So let's take an example using multiple time frames, and let's say, for an example, the E-mini S&P futures contract that I trade. Let's say I'm using a 3-minute, a 5-minute and a 7-minute chart. What advice would you give to traders about choosing which chart to actually trade off? Should they trade off all 3 charts or choose their entry from just one specific time frame? What would your advice be on that?
If you're following a 3-minute chart and you see a clear signal and you've got a clear sign of strength and you've got strength in the background, you very well, you should go long because they're a low risk entry point to the long side. Then if you have caught a move, and you know you've caught a move because the close of the bar will be higher than the close of the previous bar. Now the reason that works is because professional money, once a move starts, they have to support the market. Then you might very well say, right, okay, I'll switch to a longer time frame. But if you follow that simple trending system, it keeps you in the trade longer.
Okay, I understand, but can you explain that further?
Right. Well, we call it a simple trending system because you can visually see it. And what happens is you can go back and check what I'm telling you, and I think you'll find it's correct, is that in a bull move, the close of the bar is higher than the close of the previous bar. And that's because the professional side of the market has to support the market even in a bull move. So because they might be frightened, they might lose control of it. So they have to make sure that the close is higher than the previous bar's close.
So Tom, when the market's bullish and moving up, there are times when it will take a dip down and then continue. So you'll have down bars, maybe 1, maybe 2. Do you have a specific rule for allowing for those down bars?
You are using that system. You ignore those bars that there's hardly not a lot of difference there. Within the program, we use what we call net gain. It's very narrow. I'm not sure if they understand that, but it's a device for programming. So even if the bar is down, but it's only down very slightly, you ignore that. But when you see you allow for one clear down bar, and then you'll find the next bar will be up. And that will keep you in the trade a lot longer than you would normally stay. Because no end of people ring me up and say, well, Tom, yeah, I got in at the bottom there quite easily, but I sold out too soon. But if you follow that system, the close of the bar should be higher than the close of the previous bar, and you stay in the trade until you see very high volume on one of those up bars, and then you know that trend is likely to finish.
Let's say we're in a bull move, you've been long, your trending system's working, and then suddenly you see a pretty large widespread down bar, and the next bar is also down, so that's 2 down bars widespread. Would you then exit the position with the profit you've got and wait for the next opportunity?
Well, yes, again, it all revolves around your skill as a trader. The market's gone up very often. If you get 2 down bars that's breaking your rule for the uptrend, you'll very, very often find the next bar still up because it's going up on no demand.
Okay, well that's actually quite important. So therefore, if you see a sign of weakness appearing in this bull trend, and then the market begins to roll over as per your trending system, and then it goes back up and it's on no demand, you're highly likely to come out of your position there.
It's a very handy rule for when you're long, but the short side still seems to work. And then instead of a down bar, you may allow for 1 up bar, or if the market starts going sideways a bit, if the market's still weak, you'll see, without any question, up bars, narrow spreads, probably closing in the middle or even low, and the volume is less than the previous 2 bars. Professional money knows the market's weak. It's just drifting sideways, and they're not interested, definitely, on the long side.
Okay, Tom, so we've discussed the trending system for the bull market. What happens in a bear market is the same principles apply except on the opposite. So you're looking for down bars and allowing for one up bar. Would that be the same principle?
Yes, but I would advise you to look at that system carefully on your charts and memorize it in your memory exactly what it looks like.
Thank you very much indeed, Tom. We're now going to go and take a look at some multiple time frames in different markets on the charts to show you some examples of what we've been talking about. So, we have heard from Tom Williams that it's important to trade using multiple time frames, and in this example we're going to look at a stock. The stock is actually Barclays, and it's traded on the London index. We're going to start off by looking at the weekly of Barclays. Now keep in mind, when Tom explained to us the importance of multiple time frames, he also said that it's very much an individual preference. So as part of your trading plan, which is a vital part of being a successful trader, you should decide what time frames you are going to trade. I would pick 3 to 4 maximum, and when you have decided those time frames, implement them into your plan. Now when I'm looking at trading stocks, I actually look at 3 time frames as part of my longer term strategy. So I'm going to share those here in this example. Now first of all, we can see Barclays was in a downtrend, and that downtrend began back here 23rd of February in 2007. Now this is actually being filmed in September 2009. The market declines, and the only tool that I have here in the software is the trending system, which are these red bars, and they are a medium term trending system. So first of all, from a multiple time frame perspective, I'm going to be looking at the biggest trend in my time frame first, i.e. because I'm using a weekly, a daily and a 4-hour, as you'll see shortly, I'm going to start looking at the weekly trend to give me an idea of the biggest trend possible. Now you could even go to a monthly chart if you were taking a much longer term view, such as Warren Buffett. But in this instance, I'm going to be trying to look for an entry into this particular chart that will give me a 1 to 3 month view. So we start with the weekly. We've been in a downtrend. We have some very unusual volume coming in, and I always want to look for unusual volume areas where I see very, very high volume, or indeed very, very low volume. They're all important on the chart. So I need to just keep an eye on these areas, and I want to look at where that price closes, and are we coming up into this area? And in fact, as I film this, we're back up into this previous area of resistance, which acted as a catalyst for the next leg down. So I'm very conscious that actually, if we look on the weekly chart on Barclays, the overall trend, if I was to draw a trend channel on this chart, which I shall do for you, if I take my first intersecting high here and my second high here and let go in the software, it will actually pick for me the intersecting low. I'll put on my heavy lines, and I'm going to put on these quarter lines, which you can do in the software very simply. I think these are vital, and when the price approaches these areas, then we certainly know if it approaches any of these quarter lines that we're in a very important area of what we call the playing field, which will be discussed separately. Let's click OK. Now what's interesting here is you can see we've come out on the weekly chart of this trend channel. That doesn't mean this trend channel is incorrect, okay? Because when we're out of a downtrend channel like this, we do become potentially vulnerable if we're going to buy. Okay. However, you then might look at this chart and say, well, the weekly trend from March, which many claim to be the bottom of this credit crunch, actually shows an uptrend, and that's just as important. The big picture is that there is still a downtrend in play, but the shorter term picture says, yes, I'm making higher lows on the bar here, as we can see. And so now, what is interesting is in this downtrend, we've pushed up, we've broken out the trend channel, we've had a bit of high volume, okay, and on this previous bar here, as you can see, and now we're drifting up, but the volume is actually getting less and less. Now, this just alerts me that if I'm going to buy this particular market, and I'm going to buy this stock at this level, I do have a target above me that I could aim at where this previous selling took place, and it's about 400. So I've got about a £25 move to the upside. So there is potential there. Now I've got to time my entry. And to do that, we then need to drill down to a different time frame. So we can see that from a perspective of holding this stock for 2 to 3 months, over the last 6 months, the stock has been in an uptrend. Therefore, I want to be looking to the bull side at this stage, and I'm looking for a low volume test on the weekly chart and then transfer that through to the daily, and possibly even going into a shorter chart like a 4-hour chart if I just want to maybe buy a put option or a call depending on my trading decision. The one other thing I am going to put on this weekly chart, which is vital, okay, there's only 2 things I'm really going to focus on here for multiple time frames, is the diamond trending system. Now this has actually been set, and this is very important, to the parameter of 20. Now this can be set manually or can be set as a default within the software. Let's click on OK. Now what this does, as you can clearly see now, is it smooths the trend. Now this is very important. This is actually a short-term trend indicator. But if on my weekly time frame I see red diamonds appearing and they're also showing on the daily, I really don't want to be long. I'd be nervous about being long. Conversely, when I get 2 white diamonds, as I did here, and I start to see 3 green diamonds, that's 3 weeks of consecutive green diamonds, and the market's making higher lows, then I'm looking for testing, okay? And preferably, I'd like to see some sort of stopping volume in the background, and in this case, we had 2 bouts of stopping volume on Barclays, which again, if you've got the chart, you can zoom back to the 13th of March, and you'll find the bottom there, and you can see this very clearly on many financial stocks that had been heavy accumulated, and in fact, here is the accumulation phase. It's very obvious. It's a down bar. It's a massive volume week, as we can see. Absolutely enormous. The price was marked down. It was actually the 23rd of January, and if you recall, this is 2009, the news was informing everybody that the banks were about to be nationalised. Indeed, funnily enough, I received a rumour on that week that Barclays was going out of business. As it happens, when I see this, the chart cannot lie to me. So after you see widespread down on the weekly chart here, on any stock, if you're a stock trader, but this applies to any market and any time frame. When you see that activity, you see ultra high volume, a very wide spread on a down bar like this, but the next bar up, and that's important. It's an alert now that professional money have stepped in on this bad news, and all we look for to actually take the trade, we must see a change in trend. Notice that on that week, the red diamonds continued to fall, and the market did dip back down into that area. If it dips back down into the area, which it did, and it comes down on very low volume, you can correctly assume that professional money have finally shaken out the herd and have now come down to test for supply. If there's no supply, the market will rise, which is what happened in this instance. So let's go down now and look at the daily chart. Now here I've got the scanner, and I've got you can see I've got many markets that I scan for, but here you can see I've got 3 time frames in this particular scan. And I'm also looking here in the VSA scan for any signs of confluence. You'll notice on the weekly I have green diamonds, the majority are green, and on the daily the same. Even though I have 2 signs of weakness appear, you will have red signals in an uptrend, okay? We do not want to short a red signal in an uptrend, okay, unless we have very strong evidence that it's the top of the market. And most traders make the mistake of trying to find the top, only to find the market dips just a little and then goes up another leg. You're much safer when you're trading multiple time frames to trade in harmony with the trend. We use the trending system in the Trade Guider program to assist you. And if, in simple terms, if we go to the daily chart here, we see the majority of green diamonds showing us that in that time period, if I was to count the green diamonds versus the red diamonds, you can see even when the price does dip, as it did here, and it did here, and the red diamonds came into play, when you see that on your daily chart, if you're looking at a longer term position, refer back to your weekly chart for your guide. If you then start to see 2 red diamonds, maybe 3 on the weekly, you need to be moving your stop up and be alert. Okay, it's very important. The reason actually that this market dipped sideways here, and it's actually quite obvious, markets don't like ultra high volume up bars. We know Tom keeps talking about this, and this is what caused it. We had this bar here, okay, which wasn't excessive, but the next bar here was actually a down bar and was more accumulation on extreme volume. So we had an up bar, it came back down, this would have been some sort of news, bit of profit taking, and then we see the diamonds going, and in fact now the market has gone up from its low down here of 55 up to £374. Again, all of this, the bottom here, back in March would have been bad news here and here back in January. This was the bad news phase. You can see professional money accumulating on this high volume. They have to use the news to do that, which is why Tom Williams says don't believe anything you see on the TV or in the newspapers. It's very important to take a contrarian view and let your chart reading skills take over. It will be difficult. It will be often very, very frustrating because your gut reaction will be to sell, in fact, when you should be buying. But the best place to buy in these examples is where you see a down bar like this, where it's falling in an uptrend, but the volume is low. You can see that the volume declines on down bars into that area. That is what we call a test. And finally, the most important thing we must do now is put on our VSA indicators. And we see several of them. Now you can see that this indicator here quite correctly actually showed the bottom of this market back on the 9th of March. We can actually click on the indicator, as we know, to get an explanation. But again, what brought that indicator to life was the background of the chart, which we've already talked about. You will see that back 10 years ago, this chart reacted at that level. And furthermore, most importantly, we now get the green diamonds in play. We get testing, okay, low volume down bars with the next bar up. We see red signals. Does that mean we should rush in and sell and short this stock? Not when the diamonds are green. There's your rule. If the bars are blue, which in this case indicates to me a medium-term uptrend, and by the way, these are fully changeable, so you can change these bars to green as well if you wish to align them to make it more simple for you to view. But when we have an uptrend in place like this and you see a red signal, all it's telling you is at that particular moment in time, professional money are bringing the price back down to a lower level so they can accumulate some more. And that's where many traders make the mistake of trying to think they found the top, okay, and in fact they haven't, and they get caught and the market moves up. Finally, we go back to the 4-hour chart. Now this is more relevant for traders that are looking to trade options, puts or calls, because again here on the 4-hour chart, each week you're going to get a really good feel for what's going on by looking at indications of strength, okay, on each day. Remember, every 4 hours, you can pick another time frame. 2-hour chart's very effective as well. I happen to like the 4-hour chart. And here you can see that when you get signs of strength and the 3 green diamonds come in, the blue bars are in alignment, I can then see that this is actually a rising stock, and indeed on many occasions it will come back down on high volume as it did here. Sorry, there's a low volume down bar behind it. It's a test. It's marked up here. This is high volume. It's what we call absorption volume. It's absorbing the supply to the left because they know that they want this to go higher. And this particular Barclays stock, as I say, we've continually seen this market almost snaking, and that has to happen, this snake-like look of the chart, because they have to dip it back down to accumulate some more. Multiple time frames, as I say, are very, very important in your trading. Again, if I look at some other pairings here, there's a spot forex pair, just to give you some of the ideas of the time frames I like to use. You can see here, this is the Australian dollar. We've got a 15-minute chart, an hourly chart, and a 4-hour chart. This is running live as we speak, and you can see it scanning for indicators and trending system here. And what I'm looking for simply on multiple time frames, if I see unusual volume, if everything starts to align in the scanner, I'm very interested in looking at that particular currency pairing. Again, you can see the euro. I've got some different time frames here because I sometimes like to go in and just take a short-term 10-20 pip trade on the euro. You'll also see I've got the euro yen, the British pound versus the US dollar, all being scanned live okay, looking for multiple time frame alignment, and that's what we're looking for. Alignment, okay, in multiple time frames. Does this work for commodities? Yes, you can see here some very interesting charts that I've been following here. The crude oil contract, the gold, and sugar. This is a soft commodity that's exhibited a very strong sign of weakness on the weekly chart, which I'll just show you quickly. This is where an uptrend, which has been in place here, has been marked, okay, by a buying climax. Now, this is, and when you see a buying climax like this at the top here, and you see it followed by no demand. Now, look at the volume. That's a weekly chart. When you see that followed by no demand, and you're in an uptrend, we certainly, after high volume up bar like that and a buying climax signal, would want to be very cautious about going long on that particular chart. And I've got the daily and the weekly there. And finally, let's look at the futures contracts, which you know, many of you know that I like to trade. Here, you can see some of the time frames that I look at. Okay, and what I'm looking for again is confluence. Now, as it happens, as we're filming this, you can see that on the very short-term time frame, the 1, 2, 3, we've got white diamonds. Okay, so on the short term, the market's gone into congestion, but on the bigger time frames, can you see how everything lines up? All the diamonds are in play, and we've got strength on the 15-minute. Always look at the bigger time frame, because the strength on the 15-minute will not disappear. And that works in any of the time frames you can see here. I've got the Nasdaq up there and the Dow Jones as well at the bottom, as we can see. So, to summarise this particular lesson, you must use multiple time frames. As Tom said, that's very much down to you as an individual trader. One of the biggest questions that we get asked on an email into Trade Guider is, what time frame should I trade, Mr. Trade Guider? And the answer is the time frames that suit your trading plan. If you don't have a trading plan, you must get a trading plan. Without a plan, you will not know if you're making good decisions or bad decisions in your trading. A trading plan helps you to develop the time frames that are right for your personality. And the VSA Club has much information on the trading plans and how to develop them. So in this module, the lesson is use multiple time frames, use the scanner to identify confluence and alignment, and then execute your position with your stop and follow the trade through using the time frames that you've chosen in your plan.